Good morning. This is Vance Williams out of Seattle. It's Wednesday, April 20th. There's very little news out today. Basically, we're unchanged from yesterday. That means the sentiment would be slightly bearish for the US dollar. I did see an article where Trump said that he would keep interest rates low, close to where they are. And I thought a little bit about that because I've been kind of hoping interest rates would go up, so people could save money, so we could kind of return to a free market. But I sat and thought about it a little bit, and I realized that it would be very difficult to raise rates very much because of the housing market. And to give you an example, when I bought my first house in the late 80s, I was paying 10% interest, and I thought that was pretty good. But the house was only $60,000. Today, that same house sells for about $225,000. Now, at the time, 25 years ago, I was earning around $20 an hour, and I don't think wage growth has kept up with inflation. So what I'm saying is that if I were 22 years old making that purchase today, adjusting for inflation, if the interest rates were even 6%, I probably couldn't afford the payments. So we might just be trapped in this state of the economy, just as Japan got trapped in this way when they did this in the 90s. And by did this, I'm referring to the basic policy of quantitative easing. Basically, everybody in power gets hooked on cheap money, and then So I don't know if we're ever going to get out of this. I think this might be the new normal. So just a little perspective there this morning. Let me take a look at currency right now. One of the things I was watching just before we started, I was looking at this level here, and I could bring that up just a little bit. Yeah, that's pretty good. And you can see the 30-minute close just below that. When I go down to and I need to drop that down just a tad. Okay. And when I drop down to the 5-minute to kind of zoom in a little bit, we do have this little bit of anomaly here. I don't really ever worry about when one dips down because, that could just be some temporary news or just some one-time orders that were picked up. So I tend to ignore stuff like this and go with what's very common. So this is showing the sellers closing slightly below with a pretty nice pullback here, but it's a little bit iffy. It's not quite the clean, beautiful thing that I look for. Let's come back to that in a minute. Let's go to the pound 30-minute. As you can see, I've defined a range with a supply line here. That's a TD line here showing that any change on the 30-minute would show movement above here. And obviously you would have this. These kind of line up almost exactly here. Let's go with this period of resolution here. And I would, again, what I do here is I tend to stay right at the candle bodies because that shows me in that period of time where the buyers and sellers were at 50-50 interest. So you can see right here, we're just kind of defined in a range. This is the bottom of the range, this is the top, and the total range is about 46 pips. So not a lot going on there. Now the euro is trying to break this downside, and you've got right now in this period of 5 minutes, it looks like a little bit of a change, but in this 5 minutes, the buyers brought it all the way back up here. So I think we need a little bit more of a close. I'm going to say today, just because of the uncertainty in the market, I'm going to go ahead and say we need to close below that on the 5-minute to show any real advantage on the part of the sellers. Let's see. Since London opened, we went up and we went down. So this is a good point. One of the things that you'll notice is when London opens around 3 a.m. Eastern, they tend to establish a direction in the market. And here they did, and it only moved up about 32 pips, and then it moved down even more. So what this would be pointing to right now is a further move to the downside. So I think it would be risky to enter inside of this range So that's why I just wouldn't take this. But if we closed down here, I would enter pretty much anywhere and go for a small amount, say 8, 9, 10 pips, depending on a couple of factors. So the pound's giving us nothing. The euro, thinking about it. As you can see, there's a lot of buyers in here as well. As I said before, one of the things about doing this in a kind of a group setting as opposed to a broadcast is I can pause the recording. Here I can't. So I'm kind of used to clicking pause and just so we don't end up with dead air. But I can't do that here. Let me show you real quick where you can go and get the book, free book. You don't need to put it in your email or anything. You know, I'm not going to put that in the oops, let me go back to screen share. I'm just going to show you on a web page. I'm going to type it in today. Basically, you just click on this anywhere on this yellow area right up here. And as you'll see, I don't even require an email. And this book, basically, my goal was to take all of my 11 years of experience as a currency trader and as a trainer and show you exactly how all this works. So there's no book quite like this in the world. And it's just yours for free. And I don't have anything to sell right now. I've been considering opening up my training, but I've been a little bit busy, so I'm just not doing it right now. There is a low-cost community thing you can do. I'm not really wanting people to join that, just so you know. I retired a year ago. The reason why I'm here is I have continued to work with the traders who are on our team, and I've enjoyed it. So as you can see, I've only done a few broadcasts. Just started a few days back, first time in a year. Okay, so anyway, read that book. That's the real deal there. I mean, some of you are going to be disappointed when you see how much work it actually is to become a currency trader, but that's better than you losing all your money doing something you think is going to work but won't actually work. So it doesn't look like the euro is going to give us anything right away. You might have seen us take a trade yesterday. If you saw that, let me just show you how that trade worked out. Let me reset this and scooch over here. So if you were watching yesterday during the live session, price was here, pulled back. I entered right here at 50%, had a stop here. And as you can see, right after we closed out the session, maybe 5 minutes later, it went up and hit the target and did just a bit more. So on that trade, there was about 20 in potential before it pulled back. It never actually reached the stop ever. So that was a pretty decent trade. So you can watch yesterday's broadcast to see that setup if you want. All right. Yeah, this is looking to me like it's going to go. But again, I just can't enter in this range. The only time I would enter in the range, let's say that I had a close below this level and, you know, it was very clear. I don't like this this long tail here. This long tail here is showing me there's a lot of buyers camped out right here. But if I didn't have this long tail, I just had a nice little close here. The one exception for me entering inside of the range is if there was high impact data. So let's say, for example, retail data for the U.S. Is coming out in a minute, and so this has been going down. It's been moving. And the retail data is a little bit off. Let's say that it's a tiny bit negative for the US. That'll tend to fire currency back the other way. I love it when that happens because one piece of data doesn't usually change any kind of trend. So what that does is when it fires up in here, it gives me a great price, small stop loss, and easy target. But outside of that, outside of a high impact economic event, I do not like entering inside of a range. So in other words, I don't mind entering in a range if I think it's falsely being driven in there. That all said, I think this is we're gonna get a bit of a drop. This looks just too messy for me, so I'm not gonna touch that today. Pound's looking a little bit positive on the buyers right now. Now, I don't trade these other currencies, but I do kind of glance at them. Why don't I trade the Australian US dollar? Well, as you'll read in my book, the US dollar is about 40% of the Forex liquidity, and the Australian dollar is about 3% of Forex liquidity. So you've got a currency that represents 40% of all the money in the world versus one that represents about 2 or 3%. So that's why I don't like it. Same thing with the Kiwi. Yen, massive manipulation. I would stay away from any yen trade. U.S. Canadian is very closely correlated with the movement of oil prices, but not as predictable as the euro and the pound. Cross pairs, U.S. dollar franc, don't go near the franc. That's where you'll basically be in bed with the Swiss bank, who almost wiped out 2 brokers. One of the biggest brokers in the U.S. Not that long ago. So again, manipulation factor on the franc, manipulation on the yen. So I would suggest just staying with the euro and the pound, and there are very logical reasons for that. The amount of money, that's about the euro, the pound, and the dollar are about 70% of the liquidity in the Forex market, maybe 65 now. The behavior is more consistent, which makes it more predictable, which makes it more likely that you're going to be able to do it. All right, I need to go grab another screen here. There we go. All right, so it doesn't look like anything's going to happen, guys. Nothing soon. So I don't want to just sit here talking about nothing. Read my book. If you've got a Gmail account, you're welcome to write to me. VanceWilliams@myself.com. You're welcome to join me on the Hangout and ask questions if you like. But that's about it for now. Hope you got something out of the session. Hey, if nothing else, if you don't trade right now, you won't lose money because you're overexposed to risk. Bye, everyone.